Hey, it's Jeff Green with Green Financial Group. Thanks for tuning the video blog today. Today, we're going to talk about market versus economic cycles and sector rotation. So we're filming this video out of the new office. This is my new office. It's not all complete. And we're also going to be changing up how we do these videos here very shortly as soon as we get things calmed down. But what I want to talk to today is how the market reacts versus how the economy reacts. Because there's two different things. So take a look at the chart here. And this is what this chart is really showing you kind of where the market, we're speaking in generalities here, okay? So none of this is carved in stone, and in every instance is always a little bit different than the other one. But this will kind of show you a little bit of what the market is doing versus what the economy is doing. Because usually you have to understand the market, the stock market, so to say, is a forward-looking mechanism, right? So it's looking out 6 months or so ahead of where the economy really is. So if you look here at the far left, the bottom here, the far left, you'll see a market bottom. What goes on at a market bottom, right? So one might say that if you believe we're not in a recession, as I believe we're not in a recession at the moment, and I can point to, we've talked about these videos, I've talked on this, I've talked on podcasts. We're not in a recession. That's fodder for another debate. But I think for sure we are headed for one. And best guess, the Fed, I believe, will eventually put us into recession by raising rates so aggressively. Now, my belief is that recession is probably going to actually get here around mid to late 23. That's an opinion. So let's just assume that's the case for right now, just for argument's sake as we talk about this. So, is the market at a bottom? I don't know. No one knows until it's all over. So, but let's just say we're in a bottoming process, for example, but we're not in a recession. So, what's the market doing? The market is pricing that recession in. It's saying, look, I think there's a recession coming, and I'm going to price it in, and we're going to price in a not a worst case scenario, but a bad case scenario as what this market has been. It's a very, very difficult year in the markets. And so when the recession, if and when the recession actually gets here, the market will have already discounted that in, and it will begin to improve. That's typically the market cycle versus the economic cycle. They don't necessarily move in tandem. So a lot of people are saying, "Oh my gosh, we've been through this terrible market, and now we got a recession coming. It's just going to get worse," and that's possible, certainly possible. Typically, not exactly how it works. The market will have already discounted that recession, priced it in prior to it actually getting here, and then begin to recover once we're beginning to feel the economic pain. Not that we're not feeling economic pain right now, many of us are, but typically the market will discount that as it goes forward. So when you look at this chart also, what typically does well at market bottoms? Well, you'll see technology on this list, finance, technology, and cyclicals at market bottoms. Why? What's been beaten up the most in this market all year? Technology. It's gotten hurt pretty bad. I mean, some of the technology, the Nasdaq's down by far more than the Dow or the S&P. So our technology, that's typically where the technology stocks reside. Not always, but a lot of them reside on the Nasdaq. So they've been beat up the most. So it kind of goes with the territory. That which is beat up most is going to start to rally and typically do better as markets recover. And so again, you get to the market top here on this graph, and now you're starting to look at, you don't know when you're at the market top until it's already behind you, right? So, but at market tops, and because the market is looking forward, that's when you like basic materials, energy, staples. Now, I mean, you can look at energy again. This is why this graph that you're looking at is just generally speaking, because right now we're seeing energy do very well. And that's for different reasons, right? So You can't just look at this graph and say this is exactly how it's going to be. This is exactly how it is, because it's not. But in a general format, this is kind of how market cycles work versus economic cycles. And when you see late bear market, what does well? Healthcare, utilities, sometimes finance. I don't think the finance stocks right now are doing all that well. Financials aren't really doing that well. But certainly healthcare and utilities have done well. Now, they've been pulled back here recently as well. But, and by the way, we're filming this on October 7th, so this won't get to you for a couple of weeks. So everything I say right now about whatever, the healthcare going down may be, already old news. So anyway, I just want to put that out there. So again, you'll see different stocks and different sectors in the economy do better at different times during the market cycles and versus the economic cycles. It's sector rotation based on relative strength. That's how we manage money here. We look at sector rotation based on relative strength. We just simply follow where the money is going. It's not rocket science. But it has served our clients well for the most part, we hope. And so, but talk with your financial advisor about market cycles versus economic cycles, and the sector rotation is right for you. Thanks for tuning in the video blog today. Remember, any questions, concerns, comments, feel free to reach out to us. Remember, stay the course.